At first glance, India's Oil and Natural Gas Corporation looks like an unstoppable machine, churning out massive returns for the 2026 financial year. To measure the actual scale of that performance, we have to look directly at the company's audited standalone financial statements. Looking at this statement of profit and loss, the top-line revenue from operations sits at an enormous 132,508 crore rupees over the last 12 months. And even after stripping away operating expenses, exploration costs, and standard taxes, the bottom line shows a retained net profit of nearly 33,000 crore rupees. But headline figures on a profit and loss statement are designed to tell the most optimistic version of a corporate story. To find the reality behind those numbers, equity analysts skip past the revenue and turn straight to the independent auditor's report. This is where third-party accountants are legally obligated to flag anything that threatens the company's stability. In ONGC's case, the auditors have drawn strict attention to several multi-billion-dollar issues buried in a section called the emphasis of matter. Valuing this energy giant requires us to dismantle its profit engine, map exactly where the board is deploying its capital, and quantify the massive shadow risks these auditors have exposed. Understanding the actual health of this giant requires looking past that 33,000 crore figure to see how that money is made and exactly where it might be lost. We begin by breaking down that top-line revenue to see exactly where the cash is coming from. ONGC extracts its resources from two distinct geographic theaters. The first is its deep-water offshore drilling operations. The second consists of its land-based rigs operating onshore. To understand which of these environments actually drives the company, we have to isolate the segment revenue, the raw cash coming in, from the segment result, which is the actual operating profit before tax. This chart breaks down the total revenue. The offshore segment generated 92,406 crore rupees, while onshore operations brought in 40,101 crore. The top-line data shows a clear asymmetry, with offshore extraction bringing in roughly 2.3 times the cash of the onshore rigs. But when we transition from raw revenue to actual profit before tax, the operational efficiency of these two segments diverges sharply. Despite generating less than a third of total revenue, the onshore operations yield a razor-thin profit. The offshore profit is an astounding 5.5 times higher, carrying the vast majority of the company's margin. This reliance on offshore efficiency becomes critical when we look at the macroeconomic trend, where total revenue slightly contracted from the previous financial year. That minor top-line contraction correlates exactly with the slight dip we see in ONGC's overall net profit for 2026. The company's financial stability rests almost entirely on these deep-water platforms, where high margin efficiency compensates for the far lower returns of its land-based operations. Knowing exactly how ONGC makes its money allows us to evaluate how the board of directors is spending it. The latest board approvals show a distinct strategy to use that offshore cash to secure the company's physical supply chain and lock down logistics. The first major allocation is a heavy investment in domestic infrastructure in Gujarat. The board has authorized a 50-50 joint venture with the Gujarat Maritime Board. They are financing a 5 million metric ton per annum liquid port at Dahej. This establishes a hardened, company-controlled port facility to secure their energy logistics backbone. The second directive extends that capital leverage beyond India's borders to backstop their international exposure. The board authorized a $325 million parent company guarantee. This guarantee is routed through their subsidiary, ONGBV, to the operators in Brazil, specifically Shell Brazil Petroleum, to cover future abandonment liabilities in the BC-10 offshore block. A parent company guarantee means ONGC is legally pledging its own domestic balance sheet as collateral. If the subsidiary defaults on those Brazilian liabilities, the parent company is fully on the hook. ONGC is taking the cash surplus pulled from its offshore wells and converting it into physical supply chain control in Gujarat, while simultaneously underwriting the risk of its ventures in South America. But aggressive expansion requires a pristine balance sheet, and this is where the independent auditors step in to outline the threats the board isn't highlighting. In corporate auditing, an emphasis of matter is a specific formal warning. It points out unresolved issues that are technically disclosed, but possess the sheer magnitude to fracture the company's financial foundation if things go wrong. For ONGC, the auditors have flagged a massive stack of contingent liabilities. These are potential future debts that depend entirely on the outcome of unresolved legal and regulatory battles. The first major risk is an ongoing arbitration involving a production sharing contract for the PMT joint venture. The Directorate General of Hydrocarbons has leveled a staggering demand against ONGC for $1.62 billion, equivalent to over 15,000 crore rupees. The second risk involves a complex dispute with domestic tax authorities. Authorities have levied heavy service tax and GST penalties on crude and natural gas royalties, totaling nearly 2,200 crore rupees. The third risk cascades out of ONGC's broader joint venture ecosystem. ONGC's joint venture partners have failed to pay their own share of taxes and interest. Because ONGC is tied to these ventures, they are facing a contingent liability of nearly 6,700 crore rupees for partner debts they didn't create. By strict accounting rules, because these legal battles are unresolved, none of these figures are currently subtracted from the company's primary balance sheet. They sit off to the side, invisible on the profit and loss statement. But combined, they form a 24,000 crore rupee shadow balance sheet, a latent legal threat poised to wipe out shareholder equity if these rulings go against them. When we zoom out, we can finally evaluate the actual strength of ONGC's financial architecture. On one side, the company remains a highly solvent cash engine, fueled entirely by the heavy margins of its offshore platforms. They are taking that cash and acting decisively to secure domestic ports and guarantee their overseas drilling rights. But on the other side sits the heavy reality uncovered by the auditors, over 24,095 crore in contingent liabilities. That means an amount equivalent to roughly 73% of the company's entire annual net profit is currently mirrored by unresolved legal and tax disputes. For anyone building a financial model on this company, that ratio is critical. If even a fraction of those liabilities solidify into actual debts, the top-line revenue won't be enough to protect the margins. Building an equity valuation of a headline profit number while ignoring the emphasis of matter footnotes guarantees a flawed analysis. To accurately predict ONGC's future value, calculating the risk hidden in the fine print is just as necessary as tracking the global price of crude oil. When we zoom out, we can finally evaluate the actual strength of ONGC's financial architecture. On one side, the company remains a highly solvent cash engine, fueled by the heavy margins of its offshore platforms. They're using that cash to secure domestic ports and overseas drilling rights. But on the other side sits a heavy reality uncovered by auditors, over 24,095 crore in contingent liabilities. That means an amount equivalent to roughly 73% of the company's entire annual net profit is currently mirrored by unresolved legal and tax disputes. For anyone building a financial model on this company, that ratio is critical. If even a fraction of those liabilities solidify into actual debts, the top-line revenue won't be enough to protect the margins. Building an equity valuation off a headline profit number while ignoring the emphasis of matter footnotes guarantees a flawed analysis. To accurately predict ONGC's future value, calculating the risk hidden in the fine print is just as necessary as tracking the global price of crude oil.